All right, folks, welcome to our first video of 2020, jumping off where we left off in 2019 with the full review of the 1 to 4 family residential resale contract. So we're going to jump into the addendums, and the very first one we're going to cover is the one that's used most often, which is going to be the third-party financing addendum. So as you can see here on the screen, this is the form we're going over today. Now, I do want to point out that this is the updated third-party financing addendum. This one does not require mandatory use until March 1st of 2020, but after March 1st of 2020, this one will have to be used. There's only one really big difference, and it's just kind of like a structured difference, and we'll go over that when we get to it. But for now, at the very top, you have the name of the form, you have the address for the property. This form can be used with any of the TREC promulgated contracts. It's the same addendum for all of them. Doesn't matter if it's farm and ranch, doesn't matter if it's 1 to 4 family, new home sales, condos, doesn't matter. So the very first section that we're going to go over, and as always, we're going to read through it, and I'm not going to read every single part of this because it's somewhat redundant, but we're going to go through each part and then we'll go back through and cover all the details. So this says, Section 1, type of financing and duty to apply and obtain approval. Buyer shall apply promptly for all financing described below and make every reasonable effort to obtain approval for the financing, including but not limited to furnishing all information and documents required by buyer's lender. Check applicable boxes. It's boxes because it could be more than one. And so the first loan that we see here is the conventional loan or the conventional financing. The next one is the Texas Veterans Loan. We have the FHA insured financing loan, VA guaranteed financing, the USDA guaranteed financing, and then reverse mortgage financing. So I'm not going to read the detail for each one because we'll do that when we go over the section. But for now, let's jump back up to the top and go over the very first couple sentences to make sure we're clear on the understanding there. So the first part of this reads, buyer shall apply promptly for all financing described below and make every reasonable effort to obtain approval for the financing, including but not limited to furnishing all information and documents required by buyer's lender. This is important because the buyer has an obligation under this addendum, meaning it's a part of the contract, to go out and get the financing that they say they're going to get. I have seen circumstances before where buyers go, well, you know what, I just won't send the lender my documents and then they won't be able to approve me and I'll just terminate based on this addendum. That doesn't work. If your buyers or your buyers on your listing are not providing the lender with the required documents, they are in default of this contract because the addendum is part of the contract. So it's really important that buyers understand that if they haven't already applied for financing, they have to, and they have to do it reasonably soon after you execute the contract. And you have to reasonably put in some decent effort to go ahead and get that financing approved, including sending docs to the lender. So that's really important. So you can't just not work with the lender, not comply with what they need, and then just say, oh, it wasn't approved, and have them back out of a contract. It doesn't work that way. So the first set of financing we'll talk about is conventional financing. This is your conventional loan. It's beyond the scope of this video to talk about the different types of loans and the ins and outs of those loans, but suffice to say, those with really good credit and some money to put down can usually go conventional. So the first box says that a first mortgage loan in the principal amount of, and then there's a blank. This is the amount that's being financed. It's not the sales price. It's not the down payment. It is the amount being financed. So if I'm getting a $500,000 loan, if I'm purchasing a $500,000 property and I'm putting down $100,000, my loan amount is $400,000. So $400,000 would go in this box. You do not include any financed private mortgage insurance premiums that are put in there. So it's just the loan amount. So the purchase price minus your down payment is your loan amount. That's what goes in there. Due in full and there's a blank number of years. So if it's a 30-year note or a 20-year note or a 15-year note, that's what goes in there. With interest not to exceed, and there's a blank for a percentage. This is probably going to be your percentage that you've been quoted from the lender for the loan. Per annum for the first blank number of years. So if your client's loan is going to adjust at some point, all right, This is just talking about the first however many years. So if it's a 7-year note where it's going to adjust after 7 years, you'd put 7 years in here. Most loans, not all loans, but most loans are going to be 30 years, not to exceed their interest rate for the first 30 years of the loan. So that's probably how you'll fill that out most of the time. With the origination charges as shown on the buyer's loan estimate for the loan not to exceed, and then you have a percentage of the loan amount. I usually put 1% in here. This is a way for the buyer to get out of the contract. So if you're trying to kind of CYA yourself, you might put a lower percentage, maybe 0.5% or 0.25%. And if the listing agent doesn't catch it and your buyer's origination charges exceed that, then you might have a way for them to get out of the contract. The second option here is a second mortgage. This section is identical to that first section. This is just a second mortgage. So if we have, a primary and a secondary, maybe it's a jumbo loan and maybe they're going to, have a $600,000 first mortgage and then maybe a $400,000 second mortgage. That's how you would set that up inside of this form. Then the next section we have is the Texas Veterans Loan. And this is a loan from the Texas Veterans Land Board of blank amount. Again, this is the loan amount, not the sales price or the down payment, for a period in the total amount of, and then you have the number of years that the loan is going for at the interest rate established by the Texas Veterans Land Board. That's pretty self-explanatory there. The next section is probably your most used section, is going to be the FHA. It reads as follows: FHA insured financing, a section blank FHA insured loan. Now, FHA has a handful of different types of loans. You have the 203B, which I believe is the most common. You have the rehab loan, where you can kind of roll in some of those rehab costs, and a couple others that are in there. Again, outside the scope of this video and this training to talk about the different types of loans. But whatever section, whatever type of FHA loan you're using needs to go in that blank. So if it's 203B, it's a section 203B FHA insured loan, or if it's some other type of FHA loan, you're going to put that in there. So a section blank FHA insured loan of not less than blank. Again, this is the amount of money that you're borrowing, excluding any finance, mortgage, insurance premiums. Amortizable monthly for not less than, and you have the number of years of the note of the loan, with interest not to exceed, and then you have their interest rate per annum for the first blank years. Again, it's usually going to be the same amount as however long the note's going for, of the loan, with origination charges as shown on buyer's loan estimate for the loan not to exceed a blank percentage of the loan. And again, that's very similar to the section above under conventional financing. And then we move on to VA guaranteed financing. A VA guaranteed loan of not less than, again, the amount you're financing, amortized monthly for not less than the number of years of the loan, with interest not to exceed your interest rate per annum for the first blank number of years. Or if it's going to adjust, it's going to be shorter, but if it's the same interest rate for the whole loan, it's going to be the same amount of years in both blanks. With origination charges as shown on buyer's loan estimate for the loan not to exceed a blank percentage. Again, we see some redundancies here in this section. The USDA guaranteed financing is next. A USDA guaranteed loan of not less than blank amount, excluding finance funding fees. Amortized monthly for not less than blank number of years, with interest and so on and so forth. This is exactly the same as above. And then we have the reverse mortgage financing, which says a reversed mortgage loan, also known as a home equity conversion mortgage loan, in the original principal amount of, and then you have the amount of the loan, excluding any PMI, with interest not to exceed a blank for the first number of years, origination charges, and then you have the option of whether or not the reverse mortgage loan will or will not be FHA insured. Again, a lot of redundancies inside of this particular section here. It's just important to know that the amount that goes in these blanks for how much you're borrowing is the loan amount. It's not the sales price, it's not the down payment, it's the loan amount. If you have questions or trouble filling this out, you can do one of two things. You can talk to your lender, your client's lender, and ask them these questions and what they want to have put in here. Or you can also go and talk to your broker, or if you have a mentor, if you are being supervised by somebody on a team, you can go talk to them. but it's really important that we get the correct information in here. One thing that I'd like to touch on very quickly is that there's a question out there of, can you just change your loan mid-transaction without any repercussions? And the answer is, it depends. If your client can close the loan, can close the deal, purchase the property with a different loan, and it requires nothing else of the seller, then that's probably not a big deal. If you were, for example, going to have an FHA loan and you instead to go conventional, that usually doesn't require the seller to really do anything, and as long as you can close on time, you're usually okay. However, if switching your loan type causes the seller to have to go through some extra steps or make extra repairs, or it affects the appraisal, or something changes because you changed your loan, that's where you get into a little bit more of a gray area. FHA loans, VA loans, USDA loans all have a lot more stringent inspection requirements when it comes to the appraiser going out and inspecting the property compared to conventional. And so if you're going from a conventional loan, that's what you told the seller you were going to use, and now you're going to an FHA loan, and you have to sign an amendatory clause with that and stuff like that, the seller can always just say no. And if the reason you can't get financing is because they said no to some type of requirement that's only required under that new loan, you could run into a problem. So you want to make sure that you avoid doing that. So, all right, that's the first paragraph. Let's move on to the second paragraph. So while the first paragraph talks about the type of financing that your buyer will be using, the second paragraph talks about the approval of that financing and how that affects their ability to perform or need to perform on the contract. So it reads in part, approval of financing. Approval for the financing described above will be deemed to have been obtained when buyer approval and property approval are obtained. Time is of the essence for this paragraph, and strict compliance with the time for performance is required. Section A is buyer approval, and there are two options. The first option is, this contract is subject to buyer obtaining buyer approval. If buyer cannot obtain buyer approval, buyer may give written notice to seller within blank days after the effective date of this contract, and this contract will terminate and the earnest money will be refunded to buyer. If buyer does not terminate the contract under this provision, the contract shall no longer be subject to the buyer obtaining buyer approval. Buyer approval will be deemed to have been obtained when the terms of the loan described above are available and the lender determines that buyer has satisfied all of the lender's requirements related to buyer's assets, income, and credit history. The second option is just that the contract is not subject to buyer obtaining buyer approval. The second paragraph, B, is property approval. If buyer's lender determines that the property does not satisfy lender's underwriting requirements for the loan, including but not limited to appraisal, insurability, and lender required repairs, buyer, not later than 3 days before the closing date, may terminate this contract by giving seller notice of the termination and a copy of a written statement from the lender setting forth the reasons for the lender's determination. If buyer terminates under this paragraph, the earnest money will be refunded to buyer. If buyer does not terminate under this paragraph, property approval is deemed to have been obtained. All right, so let's go back through this. So the first thing I will note here is that this is the new form required for use as of March 1st, 2020. And the structural change is to take the time is of the essence provision, and instead of having it at the end of paragraph 2, it's right up there at the top, right at the beginning before you select any of the options. It is a nice big bold print like it was previously, and it makes it clear that time is of the essence for this paragraph. So if you miss it by a day or an hour or 30 minutes, it's going to affect the terms of the contract. So in order for the third-party financing addendum to provide protection to the buyer, it allows for two types of approval. The first is the buyer approval, and the second is the property approval. So let's talk about the buyer approval first. In this provision, under the first checkbox, you have a certain number of days for the buyer to get approved by the lender. And if within those number of days the buyer can't get approved, then the buyer can terminate and walk away from the contract and keep their earnest money. So this would be the time where the lender runs credit reports, look at assets, verify employment, so on and so forth. As long as your buyer lets the seller know before these days are up that they don't qualify for financing, they'll be okay and they'll get their earnest money back. However, if these days expire and after they expire, the reason that the buyer cannot get financing is because of the buyer not being approved. Maybe they lost their job, or they spent their down payment money on something else, or they went and got a new credit card to buy some furniture for their new house, which affected their credit. If any of those reasons pop up and prevent the buyer from qualifying after these days have expired, they're not going to be able to keep their earnest money. They're going to lose their earnest money. So it's very important on the buy side, when we're representing a buyer, that we give ourselves as many days as possible. And on the seller side, it's our job to try to limit the number of days possible so that we can learn whether or not the buyer is approved and ready to go to purchase our seller's home early on, so that if they're not, we can shut down the contract and move on and find somebody else without dragging it out past where it needs to be. This is one of those things where I've seen it happen a lot, where the buyer will get all the way up to like the week before closing and do something that messes with their ability to qualify and be approved. So it is super important that we let our buyers know, don't make large cash purchases while you're in escrow. Don't open up any new credit. Don't pay off any credit unless the lender tells you that you need to do that. Do not change jobs. Do not lose your job. Do not get demoted. Don't get suspended. Anything that would affect the level of income you have coming in, don't do anything to mess with that. Is super important, especially because after these days expire, if that's the reason that they can't get approval for the loan, they're going to lose their earnest money on top of everything else. The second portion of this is simply that this contract is not subject to the buyer obtaining buyer approval. This 2A or second box, however you want to phrase that, isn't used very often, but in an example where it would be used would be like a multiple offer situation where you're trying to just get one up on somebody else, just be a little bit better, and you already know that your buyer is qualified. The lender has said, hey, we've already looked at their stuff ahead of time. We realize that they're good to go, so we're not worried about it. At that point, you may check that box, but you really got to make sure that the lender says they're good to go as far as being a buyer is concerned, and you really have to make sure that the buyer understands that you cannot do anything to mess with that. Super important right there. The next paragraph, the property approval, this one has a lot of ins and outs that go with it, but basically in order to be able to get a loan, the buyer has to be approved, right? The bank wants to know that or I should say the lender, may not always be a bank, but the lender wants to make sure that the buyer is going to be able to pay back the loan. And then they also want to make sure that if the buyer dies or if the buyer defaults and they have to take the property back, that the property that they're loaning money on is worth enough money to cover the amount of the note. They want to make sure the collateral is good. And so it requires property approval as well. Now, you have to remember, when you're going through the lending process, the underwriting guidelines are different for every lender. Every type of loan has different sets of underwriting guidelines, and the property needs to meet all of those underwriting requirements, all of them. So it lists 3, but it doesn't limit it to 3, but the appraisal, the insurability, and any lender required repairs, those are probably the most, how do I say this? Those pop up most often in these transactions and have to be dealt with. The one thing, though, that I want to make clear before we move on is that people often think that if a property doesn't appraise for value, that means that, they just have to walk away from the loan, that it didn't appraise. And that's not the case, especially when clients are putting down large down payments. So as an example, if I have a client that's under contract on a house for $200,000 and they're putting $100,000 down, 50% down, and that property comes back and says, it's appraised at $190,000, so the appraiser says, that bank or that lender may still make that loan. They might say, hey, they're putting 50% down. We're okay with the value being only $190,000 because at the end of the day, our note's for $100,000, and if we have to come back and take it, it's going to be worth that much. So just because the property doesn't appraise doesn't mean they get to walk away from a contract if the lender's still willing to make the deal. Or I should say make the loan, excuse me. So the next part of this that's really, really important, because this has changed in the recent years and a lot of people still miss this, is that if the property does not meet underwriting guidelines, you have to let the seller know that not later than 3 days before the closing date. So if the property is not approved and you need to terminate, you have to do so at least 3 days before the closing date. If you don't, okay, if you let them know 2 days before closing or 3 days before closing, 2 days before closing or 3 days if you include the day of closing, right, then you're going to terminate, but your buyer's not going to be entitled to get their earnest money back. So you have to do it no later than 3 days before the closing date, right? Not only that, you have to provide the notice of termination, and you have to provide a copy of a written statement from the lender setting forth the reasons for the lender's determination that the property is not lendable. Both of these have to be provided no later than 3 days before closing. Last year had a number of transactions. I want to say probably 7 or 8 transactions where they were our listings, and the buyer and the buyer's agent came to us, and it was probably, one of them was the day of closing, one of them was 2 days before closing, and then a bunch were like the day before closing saying, hey, lender says it doesn't work, they can't make the loan, we're out. And in all those cases, our seller was the one entitled to that earnest money, and they're the ones that got that earnest money. And so I really got to be careful. If they won't loan on the property because of the property, you got to let them know within the time frame required. The most common circumstance that I've noticed in this case is where you have lender required repairs, and the appraiser does not get out to the property to do that until a day or two before closing. Like everybody's ready to go, lender just saying, hey, we just need this to be signed off on. They go out there a couple days, the appraiser goes back out there to do a reinspection a couple days before closing and says, hey, this isn't repaired or this doesn't meet the requirements. And the seller goes, well, I'm not doing anything else. And the buyer goes, well, you have to. Seller says, nope. Lender says, well, we're not going to make the loan. And the deal dies. But because they didn't let them know at least 3 days before closing, the seller's entitled to that earnest money. So be real careful about all the timelines within our contracts, but also within the addendums that we are using for these contracts. It's super important. So that is section 2, approval of financing. It talks about the approval requirements there. The next section is really quick, and I'm going to go through it. So it's the security, and it simply says each note for the financing described above must be secured by a vendor's and deed of trust liens. So for every note above, okay, there's going to be a vendor's and deed of trust liens assigned. This makes it pretty clear up front that that's what's going to happen. So that is section 2 and 3. And so moving on to section 4 is going to be the FHA VA required provisions, and we'll talk a little bit about that. So when you're using a FHA or VA loan, there are some specific provisions and requirements that go into using a government-backed loan like that are designed to protect the borrower. They're designed to protect the federal government that's going to be insuring the loan. And so there's this required provision that goes inside of the agreement. If you read through this, and you'll notice, for those of you that have done amendatory clauses with loans like this, that they are somewhat similar. The gist of this entire paragraph is that if a property does not appraise for the sales price when using an FHA or VA loan, that the buyer can walk away and keep their earnest money. In addition to that, you'll see that this provision here on an FHA and VA loan is not subject to the limitations in 2B, which is the 3-day requirement. So let's read through this real quick, and then I kind of summarized it there for you, but let's read through it so you have the benefit of knowing what it says. So paragraph 4, FHA and VA required provisions. If the financing described above involves FHA, insured, or VA financing, it is expressly agreed that, notwithstanding any other provision of this contract, the purchaser, the buyer, shall not be obligated to complete the purchase of the property described herein, or to incur any penalty by forfeiture of earnest money deposits or otherwise, unless the buyer has been given, in accordance with HUD or FHA or VA requirements, a written statement issued by the Federal Housing Commissioner, Department of Veterans Affairs, or a direct endorsement letter setting forth the appraised value of the property is not less than, then there's a blank, or if the contract purchase price or cost exceeds the reasonable value of the property established by the Department of Veterans Affairs. The 3-day notice of the termination requirements in 2B does not apply to this paragraph 4. And then you have subsection A, B, and C. A reads, the buyer shall have the privilege and option of proceeding with consummation of the contract without regard to the amount of the appraised valuation or the reasonable value established by the Department of Veterans Affairs. If FHA financing is involved, the appraised valuation is arrived at to determine the maximum mortgage the Department of Housing and Urban Development will insure. HUD does not warrant the value of the condition, or the condition of the property. The buyer should satisfy himself or herself that the price and the condition of the property are acceptable. And C, if VA financing is involved and if buyer elects to complete the purchase at an amount in excess of the reasonable value established by the VA, buyer shall pay such excess amounts in cash from a source which buyer agrees to disclose to the VA and which buyer represents will not be from borrowed funds except as approved by VA. If VA reasonable value of the property is less than the sales price, seller may reduce the sales price to an amount equal to the VA reasonable value, and the sale will be closed at the lower sales price with proportionate adjustments to the down payment and the loan amount. So that's paragraph 4. The blank that you see here in this paragraph, it's the only blank in this paragraph, is going to be the sales price. It's not the loan amount. It's not the down payment amount. It's not the earnest money amount. It is the sales price, the total sales price that goes in that blank right there. And so, as I said before, just a summary of this paragraph. This paragraph allows FHA and VA buyers to back out of a contract without any penalty should the property not appraise at the contract price. Now, the VA and the FHA both give the buyer the ability to make up the difference in cash on the back end once the appraisal comes in, but they do not allow a buyer to agree to make up a difference on the front end. This is also one of the reasons that the appraisal addendum, which we will cover later on, is not allowed to be used with FHA or VA financing. So that's paragraph 4. The final paragraph, paragraph 5, and I know you see 5. The only thing below 5 is going to be the buyer and seller signature lines. That's it. I'm not going to scroll up so you can see the signature lines. So the last section, paragraph 5, is the authorization to release information. It states, in part, A, buyer authorizes buyer's lender to furnish the seller or buyer or their representatives information relating to the status of the approval for the financing. And B, seller and buyer authorize buyer's lender, title company, and escrow agent to disclose and furnish a copy of the closing disclosures and settlement statements provided in relation to the closing of the sale to the parties' respective brokers and sales agents provided under broker information. So this paragraph is important for 2 reasons. The first paragraph that talks about the buyer authorizing the buyer's lender to furnish the seller or their representatives with information relating to the status of the approval is important. It is perfectly within the listing agent or the sellers, but usually the listing agent's right, to contact the buyer's lender and to say, hey, where are we at in the lending process? How close are we to approval? How close are we to clear to close? Are there issues? What are those issues? What can we do to make those issues, not such a big deal? And based on the contract via the third-party financing addendum, the lender is authorized to share that information and should be sharing that information with you. So if you get a response from a lender that says, hey, I can't share any information about the loan at all, which does happen, you can simply point them to paragraph 5A of the third-party financing addendum and say, no. Here's the provision that allows you to talk to me about the loan and where we're at in the approval status, and I'd like to know whatever information it is that you're seeking. The second paragraph, paragraph B, is important because occasionally you will run into title companies or lenders that don't want to share copies of the closing disclosures or settlement statements or anything like that with the brokerages because they feel like you're not a party to the contract, and because of that, they're not going to share the information with you. I have had this as a broker happen to me a number of times with my agents, never personally, and a quick reference to 5B on the third-party financing addendum usually fixes that. That is your permission to have copy of the closing disclosure so that you can have that for your records, and so that's really important to have. So that concludes our review of the third-party financing addendum. It is probably the most used addendum that we have out there. Most transactions include some type of financing, and so you'll see this one often. If you have any questions about this one, post them below. We'll get those answered. Otherwise, I look forward to finishing out the rest of the addendums throughout the year, going over the amendment, and any other stuff that you guys think will be valuable. Thanks.